the number of compounding is getting bigger, the value is getting higher. And if the number of compounding goes to an infinite number, it is called continuous compounding. So if we invest $100 at continuous compounding, the value of that bond is $100 multiplied by E to the power of RT. So as we learned last class, 100 times ERT is almost the same with 100 times 1 plus R. And actually the continuous compounding is almost similar with the daily compounding, which is M is 665. And most interest rates in the derivatives market usually at continuous compounding. This is formula for continuous compounding. Yes, I'm going to skip this slide. So example shows that the number of compounding is getting bigger, the value is also getting higher. And zero rates means for maturity T is the rate of interest earned on an investment that provides a payoff only at time T. So it means that there is no cash flows before the maturity, and all cash flows is realized at the maturity. So this table shows that depending on the maturity, zero rate is changed like this. So to calculate the cash price of a bond, we discount each cash flow at the appropriate zero rate. So the formula in the below, so if the maturity is 0.5, the zero rate is 5. So rate is 0.05. The next one is same. If maturity is 1, the discount rate should be 0.055. So like that, we could calculate the bond price. The bond yield means that the discount rate that makes the present value of the cash flows on the bond equal to the market price of the bond. And the par yield means that the coupon rate that makes the bond price equal to the face value. Okay, so this is about maturity and bond price. So for the first one, there is no cash flow before the maturity, so we could easily calculate the bond price. So we earned 2.5 at maturity 0.2 at 3 months. So if it is semi-annual compounding, we could calculate that 2.5 times 4 over 97.5, and then we could change it as continuous compounding by the formula. And there, that fourth and fifth one is more complicated because there are some cash flows during the before the maturity. So, but the concept is that we have to discount all cash flows including coupon, at by 0 rates. So this graph shows the 0 rates depending on maturity. And forward rates is the future 0 rates that estimated today based on today's 0 rates. If R1 is 0 rates at the time T1 and the R2 is the 0 rates at time T2, we could that formula is for calculation of forward rates. So this table shows the forward rates and the relation between forward rates and the 0 rates. So it means that if we invest 1 year at 3% and then invest 1 more year at 5%, so it is almost same with invest at 4% for 2 years. So 3 plus 5 is same with 2 times 4. So if we invest 2 years at 4% and then invest 1 more year at 5.8%, is same with 3 years at 4.6%. And that formula is for calculating continuous forward rates. Upward sloping yield curve means that long-term interest rate is higher than short-term interest rates, which is normal situation. In that situation, forward rates is bigger than 0 rates and the 0 rates bigger than par yield. In the opposite situation, like for a downward sloping yield curve, the situation is converse. Like par yield is most bigger and the forward rate is most smallest. Forward FRA means forward rates agreements. It's traded in over the counter market. It's an agreement that a certain rate will apply to a certain principal during a certain future time period. So it means that the traders predetermine the future forward rates now, and then get profits difference between the real future forward rates and the estimated future forward rates. So let's say that RK means the interest rates predetermined at FRA, and RF means the forward interest rates for T1 to T2 period and calculated by today, and the RM means actual LIBOR for T1 to T2 period at time T1. The value of FRA is present value of the difference between RF and RK. So the difference between actual and estimated forward rates, the profit interest rate is changed. So when the rate RK will be received on a principal of L, it should be like RK minus RF times T2 minus T1 received at time 2. So I'm gonna skip the examples. And about duration of bond means that the weighted average of time until the bond investor receives his or her whole principal and interest. So we could calculate duration like through that formula. And duration is important because depending on the yield, the price of bond is changed. So, and in terms of duration, it is the interest rate is expressed with continuous compounding, as we said before. But let's change the continuous compounding to the compounding m times per year. So it's changed like this formula, and it is called modified duration. The duration for a bond portfolio is the weighted average duration of the bonds in the portfolio with weighted proportional to price. So it means that depending on how much money is invested in the specific bond, the weighted average of bond is determined, and it become a bond portfolios. The convexity is related to the bond portfolio. When the bond yield is changed a lot, two different bond portfolios which have same duration react differently depending on the convexity. So if depending on the convexity, the reaction is level of reaction is different. So the convexity of the bond is become biggest when the bond equally pay money at several times for the long time, and it becomes smallest when the money is paid at a few certain times. And financial institutions try to make duration and convexity make zero to avoid the risk.
Although no textbook explains derivative pricing this way, replicating underlying assets with derivative and bonds. No textbook explains this price like this, but actually this is easiest because look at these terms of equation, right? Because this term is zero, so we have directly this one, and plug this one, we have directly get delta number of shares. So actually this is the easiest way, but no textbook explain pricing like this. And then it is not just a mental brain exercise. Actually, it has a practical value. In investment bank, this kind of exercise actually happens because, for example, suppose you want to invest in Chinese stock market, but foreigners are not allowed to invest in Chinese stock market. Then should we give up? No. If we cannot invest in Chinese stock market, we can replicate the Chinese stock market and we can invest it like this. Although we are not directly investing in this French stock market, it actually CAC 40, although it is not possible in investing in French stock market, if we can somehow access derivative on this Chinese stock market, we can be much more liquid than French stock market. And if we have access to risk-free asset, we can replicate French stock market and we can invest it. So this is really have a practical value in practice. This kind of thing happens a lot. Any question? Okay. So let's go to the generalization. Generalized derivative pricing in one-step binomial tree. Suppose a derivative lasts for time t and is dependent on stock. It is definition of derivative. Stock is underlying asset, and the value of derivative should be derived from underlying asset stock. Therefore, it should be function of the stock. So that's the definition of derivative. Anyway, S0 is the current stock price, which we know that, and it can go up and down. If it goes up, then S0U. If it goes down, then S0D. Of course, you can ask, how do we know U and D? It is not difficult. I will let you know how to do that. Anyway, suppose we know U and D. So there is two scenarios. And then each scenario, we can define derivative price. When stock price go up, derivative pays FU. When stock price go down, derivative FD. Then the question is, what is the value of this F? again, we can set up the systems of equation and solve it. Once, let's use a textbook method, replicating risk-free asset with underlying asset and derivative. So in order to create or replicate risk-free asset, suppose we buy delta number of shares and short 1 unit of derivative. Okay? Then, because we have a delta number of shares, our position on stock is S0U delta. And then because we have one short position of derivative, it is minus FU. On the second scenario, when stock price go down, then again it becomes S0D delta minus FD. Okay, so our portfolio has value of this one and this one depending on the scenarios. Then, because we want to make a risk-free position, right? And we can make these two equal. Okay, then whatever happens, we have exactly same money. So one equation, one unknown delta, so we can solve it. So delta looks like this. And actually, when we solve equation, we put x for unknown parameter, right? 왜냐면 미지수를 x라고 놓잖아. We usually use notation x to solve equation. But in this case, instead of using x, they use delta. Right? Actually, there is a reason of doing that. Because this is the real definition of delta in stock market, in derivative pricing. In derivative pricing, the definition of delta is the sensitivity of derivative price with respect to underlying asset. And this is exactly that. Delta is, this is a change of underlying asset. This is a change of derivative. So these two ratio is actually delta, and that's why textbooks use this triangle delta instead of x, because this is the definition of delta. So intuitively, okay, so let's go to the next page. So since we have delta, okay, then the portfolio at time t is S0U delta minus FU, or which is the same as S0D delta minus FD, right? And then because we have exactly same money, whatever happens t times later, we can simply discount it back, so we can get present value, which is S0U delta minus FU E minus RT. And then we know the value of this one should be, because we have delta number of stock and one short position, so value of current position should be S0 delta minus FO. And this is the value of portfolio now. And this is the discounted cash flow from this portfolio. Therefore, they should be exactly the same, right? Therefore, F should be like this. Okay. Again, if we go back to delta, so the intuition is that, okay, derivative price, okay, derivative price is function of stock price, right? When stock price changes, derivative price changes. So in order to replicate, right? In order to replicate here, in order to replicate risk-free asset, or therefore in order to get the price of derivative, what we do is first we match the slope of change of the stock, slope of change in asset prices by having delta position. Right? If we have a delta position, then change of stock price and change of delta, change of derivative price exactly matches, right? Because this is the delta is by definition ratio, so it is slope, right? And having this one and having the position for the other, this is like matching the intercept term, right? In the line. Okay, so anyway, this is the price. And then next we can plug, right? This delta, we got the delta, right? Delta is the ratio between derivative price change and stock price change. And we plug this delta here, okay, here, then we have a very nice, neat expression, which looks like this, okay? Which is looks like this. F, therefore F becomes PFU plus 1 minus PFD. And then P is ERT minus D, U minus D. And then my argument is that this P is actually probability. Right? P looks like, if we think P is the probability, right? Then we have two possibilities, right? Stock price go up and go down. When stock price go up, they pay FU. When stock price go down, they pay FD. So if we interpret P as the probability, this part looks like expectation of the derivative price, right? It's a 기대값, expected value. And then if we interpret this one as expected value, then it seems that derivative price like discounted value expected cash flow from that derivative. Right? So it is a terminal value of derivative, either this one, and at expectation, and we discount it back. So it looks like net present value problem, right? Discounted cash flow. That's why I put expectation over there. So this equation seems suggesting that we can get derivative price by simply getting the expected value at terminal period and discounting it back, like NPV. But there is a critical difference between this method and net present value. Can anyone tell me what is the key difference? This looks like a discounted cash flow approach, but this is actually different from discounted cash flow approach we learned in corporate finance. What is that? No. Actually, in professional society, even in NPV or corporate finance, we have to use continuous compounding. That's easier. It doesn't matter. We can make 100 possibilities, but still same. Okay, let's go to net present value model. Net present value. To refresh your memory, net present value. Okay, net present value looks like this. Here, R is the net cash flow. There should be expectation. Okay, there should be expectation, and I the discount rate. So rate of return that could be earned on the investment in the financial market with similar risk. Okay, so actually this is net cash flow, but we don't know what would be net cash flow in future, right? So therefore, I think Wikipedia is wrong. We should have an expectation over here. We have to estimate future cash flow, and then we have to discount it. So basically, this one, and then this one should be look very similar, but there is a very important difference between the two. What is that? The very important distinction between the two is the discount rate. Look, there is a whole discussion about discount rate in this Wikipedia, right? In NPV model or discounted cash flow approach in valuation, what kind of discount rate we should use? So what is that? How can we calculate the discount rate? NPV as a discount rate is 어떻게 구해요? corporate finance에서 할인율은 어떻게 해요? How to get the discount rate in corporate finance? No, not risk-free rate. It is called the weighted average cost of capital. Do you remember weighted average cost of capital? Martin, do you remember weighted average cost of capital? WACC, weighted average cost of capital. No. Kim Chung-yeon, do you remember? Okay, that's fine. Anyway, in corporate finance, weighted average cost of capital means that we have to adjust risk of the project. So suppose there are two projects, expected cash flow is the same, 100, but although expected value of the same, they may have a very different net present value. Okay, one project can give me like exactly $100, or the other project maybe give me $200, like throwing coins. So when they give $200, when head occurs, and zero like tail occurs, something like that. So there is if there is a difference in risk, although expected value is the same, the discounted net present value can be very different. So we are all hate risk, right? We all risk averse. Therefore, the more risk, the heavily we discount. Right? That's the point. But so, right? If there is a more risk in this, we have discounted harder. But in this case, actually in this case, interestingly, we discounted with risk-free rate, right? As if there is no risk. In corporate finance, we never discount with risk-free rate. We have to adjust the risk, and if there is a higher risk, we have to use a higher value of R. So that's the key difference. So in derivative pricing, in corporate finance, we get the expected value of the F, okay, and then we discount it back by adjusting risk. In derivative pricing, we have slightly different approach. We always discount it with risk-free rate. Instead, we adjust expected value like this by using P. This is a very important difference. You should know it. Any question? 질문 있어요? 이거 아주 중요한 겁니다. 기대값을 계산하는 방식. 그거 내가 설명할게요. Okay. So in derivative pricing, so implicitly, okay, let's get aside this probability, how this happens. But in derivative pricing, we are assuming as if we are living in risk-free world, in some sense. So let's copy and paste. Then move it over here, right? And then we have to kill it minus, right? So we have this equation. Okay. Look at this equation, okay? Then F is the price of the derivative, okay? And then price of derivative, expected value of future derivative price is just risk-free rate multiplied by current derivative. So this is the kind of valuation that would happen if we all live in risk-neutral world. Okay, in this world, okay, in this world, everyone hates risk. That's the fundamental assumption of finance. Okay, without that assumption, every valuation theory will break down. So in this world, we all hate risk. We are risk averse. That's the fundamental assumption. But let's use some imagination. Okay, let's imagine that we are all living in risk-neutral world in which people are all risk-neutral. People don't care the risk. If people don't care the risk, then what do you think would happen to the people's investment decision? Anyone guess? When you invest in an asset, what kind of information do you need? Basically, we need two key information when we make investment decision. What are the two key information? Yes, risk and return. Yeah, high risk, high return. Low risk, low return. So when you make investment decision, the most important information, okay, what is the return, like future cash flow, and what would be risk of it, risk and return. But that's the normal way. But if people don't care risk, then what would be investment decision? No, that's not the answer. Okay, again, in this world, when we make investment decision, we have to consider risk and return. But in the hypothetical imaginary world in which people are risk neutral, don't care risk, how do you think they will make decision? Yes, exactly. In this world, we consider risk and return. But in hypothetical world, we don't care risk. So we all just our own interest return, right? So we, in that hypothetical world in which people are risk neutral, people make investment decisions only upon their future expected cash flow, right? That makes sense, or expected return, right? Okay, then in that case, what do you think will happen to the return of the all asset? If people make decision only upon the return, what do you think that will happen? What do you think, what would happen to the asset prices? Because people care only return, right? If an asset produce slightly higher expected return than the others, everyone will want to buy that, right? Do you agree? Because people only care the return, expected return. Alternatively, if an asset produce lower expected return than the other asset, then no one will buy them, right? Because again, expected return is the only our interest, right? Then what do you think happens in equilibrium? If people behave like that, what should happen in equilibrium? Everyone wants to invest in an asset if its expected return is slightly high, and no one wants to invest in. Actually, everyone wants to short sell it if expected return is lower than the other. If everyone behaves like that, what should happen in equilibrium in the long run? 내 질문이 어려웠나? In that situation, expected return for every asset should be same, right? Okay, if they are not same, which means that something is higher, some assets have higher return than the others, right? Then, because people make decision only on expected return, people only flock to the asset with high expected return, and no one invests in low expected return asset, right? Therefore, in equilibrium, expected return should be same for all assets. Do you agree? 그렇잖아. 아니 사람들이 리턴만 보고 투자하고 조금이라도 리턴 높은데 우르르 몰려가는데, 예? 그럼 장기적으로 모든 에셋이 리턴이 동일해져야 말이 되겠지. 예? 리턴이 남들보다 좀 높다. 그런 건 자산 가격이 올라가서, 지금 가격이 올라가서 미래 가격 대비 지금 가격 비율이 낮아져야 될 거고, 어떤 애가 싼 거보다 expected return이 낮다. 그럼 아무도 그걸 안 사려고 하니까 자산 가격이 떨어져서 이제 리턴이 지금 가격, 리턴이 뭐야? 지금 가격과 미래 가격 비율이 되라. 그 비율이 올라가야겠지. 네, 그래서 이 뉴턴이죠. Expected return for every asset should be same. Right? If we don't care risk, okay. So if we live in a world in which no one cares the risk, then expected return should be same in liquidity. Okay. Then the question is, okay, if every return generates, every asset generates same expected return, then what would be the value of that same expected return? That would be the question. Okay? At least we know one expected return for sure, right? Which is risk-free rate. Right? Risk-free rate, it is not even expected return, it is just constant, right? So we know for sure what would be the expected return of the risk-free asset. Therefore, if we apply same logic in the hypothetical world where everyone is risk neutral, expected return of the every asset should be exactly same to risk-free rate. Right? Does it make sense? 네? 말이 되나요? 질문 있는 사람. Is it difficult? Marty, do you understand what I'm saying? Kind of, sort of. Okay. 네, 김민지 학생, 이해 가요? 무슨 말인지? 이거 굉장히 중요한 겁니다. 말장난 같지만 이해 가요? 자산의 가격이 아니라 비율이 같아지는 거지. 즉 기대 수익률이 모든 자산의 기대 수익률이 동일해져요. 이 사람들이 리스크에 대해 신경 안 쓰니까 리턴만 보고 투자하니까 조금이라도 높으면 몰리고 조금이라도 낮으면 아무도 안 몰리니까 모든 리턴의 가격이 동일해져. 동일해진지 뭘로 동일해진지는 아직 몰라. 근데 우리가 확실하게 하나 하는 게 뭐냐면 리스크 프리 레이트 확실하게 알아. 리스크 프리 레이트. 아, 그래서 모든 자산 가격이 동일하고 우리가 하나는 확실하게 하니까 모든 리턴의 가격이 리스크 프리 레이트로 동일해져야 되는구나 라고 논리적으로 생각할 수 있겠죠. 이해가죠? 그러니까 예, 모든 자산의 수익률이 동일해져야 된다고 했잖아. 예, 근데 뭘로 동일해져야 되는데 우리가 궁금한 거죠. 이게 하나는 확실하게 알아. 수익률이. 예. 딱 하나만 확실하게 알면 모든 자산의 수익률이 동일해져야 되니까 그 모든 자산의 동일해진 수익률이 뭔지 알 거예요. 딱 하나 확실하게 아는 게 리스크예요. Therefore, in a risk-neutral world, more intuitively speaking, okay, in a risk-neutral world, because people don't care risk, they should expect exactly the same return, whether they invest in risk-free asset or risky asset. Right? Even if we invest in risky asset or risk-free asset, their expected return should be exactly the same because we don't care risk. Therefore, expected return for every asset should be same and same to the risk-free rate. That is what is actually going on here, right? So, if we move this one over here, you know, this is the return from risk-free asset. This is the return from derivative, right? Expected return. This is the current derivative price, and this is expected value of the derivative price, right? So in that hypothetical world, I just told you that expected return from every asset should be same, and this is what is actually going on over here. Okay, in this situation, right? Expected return of the risk-free asset and expected return from derivative is exactly the same. So actually this is a very fundamental intuition from derivative pricing. So it means that in derivative pricing, what we do is, okay, we solve the systems of equation, but more interesting way, but mathematically equivalent way of solving, getting derivative price that we simply assume, okay, we assume that we are living in risk-neutral world. We just imagine that we are living in a world where everyone is risk-neutral. Okay, and then in that hypothetical imaginary world, we calculate expected price of an asset, right? And then once we get the expected value, expected price, then we discount it with risk-free rate. We have to discount it with risk-free rate because no one cares about risk, right? And then we can get some derivative price, right? And the interesting part is that valuation in hypothetical world is actually y. Right? So again, if we go to this one, again, derivative pricing is that first we assume that we are living in a risk-neutral world, and in the hypothetical world we get the derivative expected value, and then because we are in a hypothetical world where no one cares about risk, then we discount it back. Then we can get derivative price in hypothetical world, right? Interesting thing is that derivative price we get in the hypothetical world is true derivative price. That's the interest. Although we get the derivative price in hypothetical world, that is not hypothetical value. That is actually true value. Okay, so that's the fundamental intuition of a derivative pricing, and that's why Merton Scholz got Nobel Prize. Okay, they didn't get the Nobel Prize by solving elementary school mathematics. Okay? They got Nobel Prize because of this one. They found out that in order to get the derivative pricing, we simply assume that we are living in a hypothetical world where no one is risk neutral, and then in that hypothetical world, we simply get the expected price, and then because in the hypothetical world no one cares risk, then we discount the risk-free rate, and then we get some number in hypothetical world, and then they found that valuation, that value of the derivative in hypothetical world is exactly same value in the real world. That's the most interesting part of the valuation. Do you understand what I'm saying? Actually, this is my favorite example, but does everyone watch a movie called Inception? Inception이라는 영화 본 사람? 다 봤네. Okay. So what is the storyline of Inception? Trevor, yes. Yeah, dream. Yes. Okay, so basically it is going with hypothetical world. Actually, hypothetical world is dream, right? They go into another people's dream and they do some work, right? And then in the movie, there is a female character, wife of Leonardo DiCaprio, and she's commit suicide, right? Why? Why she killed herself? Do you remember? 김미지였어요. 이 여자가 여자 주인공 왜 자살했어요? 현실이 아니라고 생각해서. Exactly. Okay? The female character, she killed herself. I forgot her name. Rachel Weisz? No. She is a very famous actor, right? Anyway, that pretty female character, she killed herself because she believes she's in dream, right? But actually that is not dream, right? So, in the movie Inception, right, the people can be confused over whether they are in dream or not. Right? So, in order to avoid the confusion, what kind of behavior they do? Yeah, totems, right? In case of Leonardo DiCaprio, he always carries a spin, and then if the spin falls in he's in real world, if the spin if the top keeps spinning, then it is dream, right? So it is exactly the same in our world, right? I put stop, so it is like a totem, is at the top in Inception movie Inception, right? We want to distinguish real world and hypothetical world. Therefore, we want to stop. That's the reason I put stop. So Like Inception movies, but there is a difference between movie Inception and our valuation. In Inception, what people do in dream and in dream, right? It may affect people's mind, but anyway, whatever they do in dreaming, it doesn't affect real world. But in our value, it is different. We go into hypothetical world, and in hypothetical world, we calculate derivative price, and derivative price is surprisingly exact derivative value we want. Okay, that's the key difference. Do you understand? Now, okay, I told you that this is the expected value of derivative in a hypothetical world. In order to get the expected value of derivative in hypothetical world, we have to get the probability, right? In order to calculate the value, we have to know the probability of each scenario, each state, right? And then I just argue that this is the probability in the hypothetical world. Okay? Because this is the probability in hypothetical world. This may not be real probability of this event, FU, or stock price going up. Okay? But then there is a question remains. If this is expected value, then this should be the probability, and if that is the probability, it should satisfy the axiom of the probability. Right? What is the probability? What is the definition of a probability? Does anyone know? What is the definition of probability? What is the probability, Martin? Correct. Okay. We learn probability in high school, right? But interestingly, in high school mathematics textbook, there we solve problems about probabilities. But in high school textbook, they don't define what is the probability exactly. Okay. When I learned mathematics in high school, we have only one textbook, and there was problems about probabilities, but there was no exact definition of probability. So when I learned mathematics in high school, I always wondered, what is the probability? We are using probability without defining probability. And then last 2 years, I made problems for 수시, 한양 University essay test, 수시 노트, 상경계 수시 노트. In order to make problems for 상경계 수시 노트, I collected high school mathematics textbook, and I go over the high school mathematics textbook, and I still found that textbook tends to not explaining the definition of probability. I checked 7 textbooks, and only 1 textbook explained what is the definition of probability. So therefore, it is no wonder that you don't know what is the exact definition of probability. For your information, the textbook from 신사고라는 출판사가 있는데, only the mathematics books from the 신사고 출판사 explain the definition of probability. So it is no wonder you don't know the definition of probability. 고등학교 때 신사고로 수학 배운 사람, 뭘로 수학 배웠어요? 고등학교 수학 배웠어요. 교합사? 동아 출판사? 부산동아? You cannot remember? Okay. So let's check what is the definition of probability. Kolmogorov axiom. Okay, what is the definition of probability? We can have an axiomatic approach of a probability. To use easier words, to explain more easily, probability, we can define probability. Probability is basically function, and we call a function as a probability if it satisfies three criteria. In mathematics, we call axiom. So if it satisfies three principles, we call that as a probability. Okay. So what is the first criteria or first axiom? Probability is a basically function. Okay. Function from event space to real number. And interestingly, the child, okay, domain of the function is positive. Okay, so it is basically function from some space to real number, but not negative number. The domain of the function should be greater than equal to 0. Okay. Second axiom. P omega should be 1. It means that the probability of anything happens, okay, probability anything happens should be 1, right? Which means that probability of nothing happens should be 0, right? So it means that if we combine first and second axiom, it means that probability should be between 0 and 1, right? Third one is that if there is the event like E1, E2, and if they are mutually disjoint, like drawing coin, okay? If we draw coin, it should be either head or tail, right? We cannot have a state in which we have both head and tail, right? It is impossible, right? So we have two disjoint states. So the probability of the union of the disjoint state is simply sum of the probability of each state, right? Therefore, since head and tail cannot occur together or together simultaneously, probability of either head or tail is sum of probability of head and probability of tail. So if a function satisfies these three axioms, we call that as the probability. Only 신사고 textbook explains this. This is very important. So let's apply these three axioms into our situation. Okay. Only when P is the probability, we can call this one as expected value. And then we have this hypothetical situation of calculating expected value of discounting risk premium. Right. So let's start from third axiom. Okay, we have two states, right? Stock price go up and down, right? And those two states are mutually disjoint. We cannot have the state in which stock price can go both up and down. Right? That's impossible. Right? So, and then stock price should go either up or down. There is no other possibility, right? So, if the probability of going down should be 1 minus P, right? Therefore, the sum should be 1, right? So, P 1 minus P, okay, it satisfies the third axiom. Now, more important one, we have to check first and second axiom. First and second axiom says that P should be between 0 and 1. Okay? Let's check whether this is between 0 and 1. First, is it greater than 0? How do you think? How do we know that this is greater than 0? It is possible that it can be negative. How do you think? Do you think that P can be negative? Why? Okay, so why P should be more than 0? Why? Okay, if P is greater than 0, okay, if P is greater than 0, why should we conditional that? In order to make greater than 0, what kind of relationship should hold? Okay, when P can be negative in the equation, okay, in order to make P negative number, what should happen? No, again, my question is, if P is negative number, when P becomes negative number, just look at the equation, ERT minus D over U minus D. Then, no, where is expectation? Where is expectation? What do you mean by expectation? That's not expectation, that's risk-free rate. What is your name? Yes. ERT가 뭔지 모르겠어요. 헷갈리면 안 되지. 그걸 헷갈리면. ERT가 뭐냐면 지금 일단은 여기 아니 그걸 헷갈렸으면 이게 무슨 말인지도 모를 거 아니야. 이게 지금 디스카운트 팩터라고 그랬는데. 네? 아니 모르면 질문을 해야지. 네? 뭐? 아니 내가 힘이 빠지잖아. 네? 이 RT가 뭔지 모르는 사람. 내가 지난 시간에 E가 뭔지 설명했잖아. 네? 오늘도 설명했잖아. 이민지 학생, E가 뭔지, 이 RT가 뭐라고? So P becomes negative, okay? By definition, U minus D is always positive, right? And if P is negative, it means that ERT is smaller than D, which means that D is higher than risk-free rate. Okay? So my question is that, is it possible? Is it possible that ERT is lower than D? Do you think is that possible? In this world, why? Why is it not possible? Yeah. Okay, rest is common sense. D is the what is the D? What is the D over there? Okay, so it's a low return. It is worst possible. We have only two cases, so it is the worst return in the possible case. So if P is negative, it means that P is negative, D is greater than risk-free rate, which means that if P is negative, the worst possible return is higher than risk-free rate. Does it make sense? It doesn't make sense. It's like, okay, we have Samsung Electronics. Suppose stock price of Samsung Electronics, we have possible returns in future of Samsung Electronics, right? If worst possible return of the Samsung Electronics higher than risk-free rate, what would happen? Yes, there is arbitrage opportunity. It means that whatever happened to Samsung Electronics, what kind of damage happened in Samsung Electronics, the stock of the Samsung Electronics will produce anyway higher return than risk-free rate. So in worst case, it produces higher than risk-free rate. Therefore, it is even better than risk-free asset in every possibility, right? So if we borrow money and invest in Samsung Electronics, it is impossible to lose money because worst case is the higher than risk-free rate, right? Of course, that shouldn't be possible, right? Because that means there is arbitrage opportunity. Everyone wants to borrow money, invest in Samsung Electronics. Therefore, P should not be negative. Moreover, P should not be exactly equals 0 either. P should be strictly positive. because if it is 0, worst possible case of Samsung Electronics is risk-free rate, and it means that we have a strict positive, we have a probability, positive probability that we have to make money. So if we invest, if we borrow money from the bank, invest in Samsung Electronics, I don't invest anything, but and then worst case is break even, and I have a strict positive possibility that I make money. So again, it is arbitrage opportunity. Everyone wants to do that kind of transaction. So it shouldn't be 0. It shouldn't be greater than, always greater than 0, right? Okay? So it satisfies the second action. The first action. Now let's take the first action. First action says that, second action. Second action says that P should be less than 1, right? So let's think about the counterfactual example. What would happen if P is greater than 1? What does it mean if P is greater than 1? Yeah, right. Exactly. If it is greater than 1, it means that this one is greater than U. Then what does that mean? Why that's the impossible? Continue. So opposite of the previous case, right? If this one is, if P is greater than 1, this is greater than U, which means that the best possible case of stock price is still lower than risk-free rate. Whatever happens, how many Galaxy S5 Samsung sells, still it cannot be risk-free rate. In that case, we have no reason to invest in Samsung Electronics, right? If we borrow money and invest in Samsung Electronics, we always lose money. Alternatively, if we short sell Samsung Electronics and invest in bank, then we always make money. So that is arbitrary opportunity. More importantly, P shouldn't be same to 1, right? It should be strictly less than 1, right? Because if it is 1, it means that the best case is the risk-free rate. And we have a positive probability that the return is lower than risk-free rate. So it is stupid to invest in that kind of asset. Okay? So it satisfies those two actions. P should be actually satisfy first and second action very in strong sense. It should be always between 0 and 1, not same to 0 and 1. Therefore, P is between 0 and 1 and satisfy all three actions. Therefore, P is the probability. So, to summarize, if there is no arbitrage opportunity in this economy, then there always exists P, probability. And that probability defines the risk-neutral world, the hypothetical world. And then in hypothetical world, we can do this kind of thing. To summarize again, this is a very important part, so I have to repeat again. So, no arbitrary opportunity. That's the very sensible assumption, right? This is the assumption we always believe. There should be no free lunch in the economy. So, if there is no arbitrary opportunity, there exists the probability P. And we can use that, and that probability actually is the probability of the risk-neutral hypothetical world. And then in that hypothetical world, in the risk-neutral world, actually, we can do the valuation in the risk-neutral world. Simply calculating expected return, right? Simply calculating expected return, and then discount it back with the risk-free rate, and then get the derivative price. And that hypothetical derivative price is real derivative price we want to get. Everything holds as far as there is no arbitrary opportunity. If there is no arbitrary opportunity, we can do this hypothetical inception exercise. That's the key intuition. Okay. Any question? Okay. And then let's investigate this P more, then the question is how do you know the P? Okay, how can we find risk-free world, right? The hypothetical world. That's actually easiest part. Okay, in the risk-neutral world, as I told, expected return of the every asset should be same, right? If expected asset of every asset is same, the expected return of even the stock should be same to the risk-free rate, right? Right? No, in the risk-neutral world, in that hypothetical world, the general principle is that if we are living in risk-neutral, that hypothetical world, every asset price should be expected return over the every asset price is same. Right? Because we are in a risk-neutral world, invest price of the value of the asset, V is a general asset. So this part, we invest this money in the bank, and then the bank will give this amount T plus T time later. Instead, if we invest in the asset, then in time T, in future, the expected value of this one, right? And the risk control, the day should be exactly the same. This is equal to this one, or this one, right? This relation should hold even for stock prices, right? Therefore, ERT should be equal, S0 should be equal to ST, right? And then what is this? How can you calculate this? What is this one? Okay, how can you calculate expected stock price? Okay, using this one. How can you calculate this one? Good, exactly, you are right. So P multiplied by U S0, right? Plus 1 minus P multiplied D S0, right? Stock price can go up and down. Up probability P, down probability P. Okay? So if there is no arbitrary opportunity, we have the risk-free world, risk-neutral world. In that risk-neutral world, we can always do this exercise. There is always exist this kind of P that allow us to do this operation, right? And then our question, what is this P, right? And this is one equation and one unknown. So actually we can solve this. Okay? Cancels out, and this is P U minus T plus D, right? Therefore, we subtract each side D and divide each side U minus D. This one becomes exactly same to this one, this P, right? So this is very convenient, right? If we are living in a risk-neutral world where no one cares about the risk, then stock price should follow this process. There is always, if there is no arbitrary opportunity, there is always exists this kind of P. And then we know every information exists P. So we can solve this P, right? Interesting is that this P is the probability of going on in the hypothetical world. And then we apply this P, okay? We apply this P and get the expected value of the derivative in future state, and then simply discount it. Then we are done. We don't even have to solve systems of equation. everything, of course, everything is derived from systems of equation. But now, once we master the systems of equation, and we know that important intuition of the inception, right? Hypothetical risk neutral world. Now, as far as we look at carefully how stock price moves, then we can calculate P out of, we can extract P out of stock price and apply that P for derivative price. Easy. That's the easy part. I think this is the good place to stop and take a break. Let's take a break for 15 minutes. It is all from that two system, two equation, two unknown problem, right? Everything is from there. And from there, we just figure out that if there is no arbitrary opportunities, it means that there exists that hypothetical world. And if that hypothetical world exists, we can go into that hypothetical world, and we can do a derivative in that hypothetical world. And the derivative price is actually the real derivative price. Then let's think about slightly more deeper. Okay, why do you think we can go into that hypothetical world? Mathematically, if there is no arbitrary opportunity, we can go into the hypothetical world. But more intuitively, why we can go into the hypothetical world in which everyone is risk neutral? Why do you think we can assume that we are in the risk neutral world and get the derivative price? Why is that? Why risk doesn't matter in derivative pricing? Right? It means that risk doesn't matter, right? We can go into the risk-free world where no one cares about risk, and then we do the valuation, and that is right, which means the risk is irrelevant. Why? Why is that? In a sense, why risk is irrelevant? Why do you think we can assume that we can go into risk neutral world? What is the fundamental reason? Beg your pardon? Yeah. Yes, that's correct. Right, that's right. In the textbook example, we combine risk-free asset and we combine asset and derivative and create risk-free asset, right? We completely get rid of risk. In my example, we replicate derivative with underlying asset, and then risk-free asset perfectly replicated, and there is no risk in the calculation, right? Thus, since we perfectly hedge out the risk in this calculation, therefore risk doesn't matter, which means that we don't have to think of risk, which means that we can assume that we are living in the risk neutral world, and there we can do the calculation. Anyway, yeah, this is the most important part. Everything, every valuation can be done this way. This is the fundamental intuition of a short black, short gold. This is simplification. We can go into the hypothetical world and do the valuation. In corporate finance, actually, we don't have this part. Instead, we change this one. Okay, P as a probability. It is natural to interpret P and 1 minus P as a probability up and down movement. It is not actually, it is possible because the axiom of the probability. The value of the derivative is then is expected payoff in a risk neutral world, discounted at the risk-free rate. When the probability of up and down movements are P and 1 minus P, the expected stock price at time T is this one. Right? This shows that the stock price on the risk-free rate in risk-neutral world. Right? Binomial trees illustrate the general result, so it is general result. It holds for every asset. This is the general result, V. Right? That to value a derivative, we can assume that the expected return on underlying asset is the risk-free rate, right? Because we are living in a risk neutral world, every asset should have exactly the same return, which should be exactly the same to risk free rate, right? That's what it's saying. General to value derivative, we can assume that the expected return on underlying asset risk free rate and discount at the risk free rate. Okay, this is no one cares about risk in that world. We have to discount every future cash flow with risk free rate. Obvious. This is known as using risk neutral valuation. So basically, we learned two methods of doing derivative price. Method one, replication. Method two, risk neutral valuation. But they are mathematically identical. Original example we visited S020, 2218, 10P1 minus 2P. If P is the probability that gives the return on the stock equal to the risk-free rate, or in my terminal, if P is the probability that holds in risk-neutral world, then expected return from the bank, investing the stock price in the bank, or investing in stock should be exactly the same. This part is invest $20 in a bank, then we have this. If we invest $20 in derivative, we have this one in future. And the risk neutral world, they should be exactly the same. One equation, one node. So if solve this one, P looks like this, and this one is also exactly 0.6523. So we know the probability is up. Okay. Since we know the probability is up, now we can do derivative pricing. We simply apply this probability. We extracted the stock price. We apply that for derivative pricing. Valuing the option using risk neutral valuation. So up probability is 0.6523. So it means that down probability is 0.3477, right? And then this is 1, 0. So expected value is simply probability 0.6523. And then we discount it back to the present of this one. The price is 0.633. Exactly the same price. And it should be exactly the same. Right? Very simple. It cannot be easier. So irrelevance of stock's expected return. Okay? Until now, right? Okay? We calculate the P this way. We assume that we are in a risk neutral world, and we get the price in the risk neutral world. P should be this one, right? Then, how about the real probability? This is the probability that would hold in the hypothetical world. But then, how about the real probability in the real world? What is the probability going up in this real world we are living in now? Answer is that doesn't matter in our derivative pricing. If P, that real probability doesn't matter, it means the expected return of the stock doesn't matter. Because if we calculate the expected value with that real probability, that will give us expected stock return, right? But then it is a bit paradoxical. Right? In the stock market or investment bank or stock brokerage firm like 삼성증권, 미래에셋, right? Goldman Sachs, Lehman Brothers. In those firms, there is a very rich guys, high-paid guys who investigating stock return, like stock analyst. What is the job of stock analyst? What is the job of Samsung Electronics stock analyst? They simply figure out target prices or fair prices. They figure out fair prices and compare that fair price with current price and basically give recommendation to investors. Buy, hold, sell, right? Buy if return is high, expected return is high. Hold if expected return is neutral. Sell if expected return is low. That's the job of the stock analyst. Their entire job is, that group of well-paid people, their only goal is to figure out expected return of the stock price. No, expected return of a stock. And I just said that doesn't matter. That's irrelevant. Which means that those people are usualists to us. Does it make sense? That makes sense. That's true. They are usualists. They are usualists, not in general. Okay. I don't want to offend them. They are good. They are maybe some good people out there doing stock analyst, being a stock analyst. It does not mean that most of them are assholes, but anyway. I'm not saying that they are entirely usualists. They are usualists for derivative pricing. In order to find out what is the correct call option price for Samsung Electronics, we don't have to know anything about future return of the Samsung Electronics. In order to get the valuation of a call option, put option for Samsung Electronics, we don't care what stock analyst of Samsung Electronics says, because anyway we will hedge out stock return. So they are irrelevant. They are usually on derivative pricing. That's the irrelevance of stock expected return. Okay, when we are valuing option in terms of the price of the underlying asset, the probability of up-down movement in the real world are irrelevant, right? This is an example of the more general result. Yeah, this is general result over there. General result. Stating that expected return on the underlying asset in the real world is irrelevant in derivative pricing. That's the beauty of the derivative pricing, right? We don't need, that's actually hardest information we get, right? That is hard, that's why we pay a lot of money to the stock analyst. That's hard. We don't need that information to the derivative pricing, and that's the beauty of the Black-Scholes equation. Before Black-Scholes, the full summary try to get the derivative pricing without this. So Paul Samuelson's approach is that he wants to get the expected value and discount it back with risk adjustment, like NPV approach. Right? But problem is that for the same underlying asset, there are many different kinds of the derivatives for different functionalities, different strike prices, different specifications. When we have different contracts, it means that we have adjusted this on every time. That's not practical. That's why Paul Samuelson failed. But Black-Scholes, they figured out that actually that hard information, it doesn't matter. Whatever derivative contract it is enough to know the risk neutral probability of each state, and each state in contract state we know how they pay. Then we can simply get the expected value and discount it back, and we can go. We don't have to adjust any risk or whatever. It is enough to know the risk neutral probability. Now, two-step example. Any questions? Until now, I think this is the every other part of this book, and this course is now simply extension of this part. This is what we are going to learn from now. Okay, in the previous case, we have only two states, right? Then two possibilities in future, right? But in real world, there are infinite possibilities, right? Then how to solve the problem? That's easy. Okay, we have layers of that binomial. So let's have a slide extension like this, two-state example. And now we have three scenarios. 1, 2, 3. Okay, in the previous example, we have only two scenarios. Now, let's consider three scenarios. Okay, if it is easy to extend n scenarios, it is extension of this one. Okay, the idea is that how many possibilities we have, we draw tree like this. And in this case, our approach is that we know how to do the derivative pricing this part, right? So what we do is we just repeat this analysis. In this case, we have an analysis for this part, and this part. We can simply repeat that calculation 3 times. Well, if that sounds too hard, we can rely on computer. We can do it quickly. We can write the logic, then compute to the calculator. So it is enough. It is sufficient to know only this part. Other part is just expansion of the part. So let's go to this example. In this case, it is only 6 months example. In the previous case, it is 3 months. Now it is a 6 months example. So as the previous case, beginning is the 20, and then 3 months later, stock price go up either 22 or 18. And then 3 months later again, then stock price again go up and down, or up and down in each possibility. Up, down, up, down. Now, one convenient assumption is that going up, down, up coincide each other. That's actually convenient assumption. This assumption can sometimes make pricing impractical, but most of the cases this assumption is correct. It doesn't matter. So let's assume that we have this assumption and go up, down, up coincide. That's the convenient assumption. Okay, that's not a big assumption. Okay, so we have 3 cases. Okay. Then, in case of the option, strike price is 21 and the risk-free rate is again 12%. Each time there is 3 months. And how to do this evaluation? Okay. We start from the backward. Okay. Since strike price is 21 in the call option, so when stock price is 24 to 2 in the call option, we can buy. Call option means that we can buy some asset at the strike price. So if stock price is 24.2, we can buy an asset whose value is 24.2 with a low price 21. Therefore, we make money 3.2. So value of the call option becomes 3.2. But when stock price is 19.8, then we have no reason to buy on asset 90.8 by paying 21. We don't want to do that, so we don't exercise asset. Exercise option, the value of option is 0. So value of option, when stock price is down, it becomes 16.0, still is 0. Okay, so by analyzing option contract, if we look at the option contract, we figure out that now we have 3 scenarios, and each scenario option pays 3.200. And the question is, what is the value of that option? Okay. We simply repeat what we learned the previous day. So in this big tree, we divide this tree into 3 parts: this part, and this part, and this part. Let's start from this part. We apply this formula, not formula, but risk neutral valuation. Now it is time to go into the hypothetical world. And then we know the risk neutral probability of going up is 0.6523, right? So we multiply 0.6523, and then down probability is 0.34770. Okay, so okay, we expected value, and then we have to discount it back with the risk-free rate. So value of the option at this point is 0.257. No, 2.0257, right? And now at this point, we have to go to this part. In this part, value of the option is what? In this case, and every possibility future is 0. So actually, it is not even necessary to solve it. So it is 0. Option price should be 0, right? 0 should be 0, right? And then we analyze this part. Okay. In this scenario, it pays 2.0257. In this scenario, it pays 0. So again, we calculate expectation between this and this, multiply this one with this probability, and multiply this one with this probability, and again discount it back, and then we get derivative price, which is 1.2823. Very easy, right? we just repeat this one 3 times, and then computer do that work. Actually, this is your midterm exam, right? You have to do this kind of analysis for large tree. Okay, you have to make tree size in general. Now, put option example. Again, let's say this is the initial stock price is 50. It go up 60, 40, and then go up like this. And then U is up probability 1.32 and D is 0.8. And then because put option strike price is 52 and put option is right to sell, okay? I have no reason to sell an asset whose value is 72 at low price. I don't want to do that, so I don't exercise the option. So option pair is 0. When asset price is 48, okay, I can sell $48 value at $52. So I exercise. So my value of my option is 4. Okay, when stock price is 32, again I can sell this one at 52, so I make $20. Okay, 0, 4, 2. Okay, now we move to this point. Okay, this probability is 6282, and this probability is 0, is 1 minus this one, and then therefore we can calculate expected value at this point. Again, this, so I multiply up probability, down probability, get the expected value, discount, so I this one. So I know the value at this point, at this point. So again, I get the expected value and discount effect, that's 4.1923. Easy, right? Then next question. What happens when the put option is American? Okay. What is American option? What is the difference between American option and European option? What is American? How American and European options are different? Yeah, I mean, you are almost right. Okay. In case of a European option, you can exercise your right only at the maturity. In the American option, you can exercise option anytime you want. So in case of call option, it's an option to buy. So European call option, you can buy an asset at the strike price only at the maturity. But in American call option, you can buy an asset anytime you want until the maturity. Put option means right to sell. In American put option, you can sell anytime you want at the specified price. Okay, strike price is 52. Strike price 52. And then risk-free rate is 5%. And then U up return. Up return is 1.32. And down return 0.8, right? And then we can calculate P, right? Then R, okay? We can calculate R, okay, gross risk-free rate is what? It is okay, T, time step. Time step is 1 year, okay? Delta T is 1 year. You don't have to write down. You can. I'll put this one in the desktop 바탕화면 so you can have this file.
gross return is exponential of the return risk-free rate multiplied by this one. Okay? Therefore, now we can calculate risk-neutral probability. Risk-neutral probability is ERT minus D divided by U minus D. Okay? So, what? I think this is wrong. Okay, I think this number is wrong. Okay, I think my number is right. Okay, so risk neutral probability is the ERT minus D divided by U minus D. So let's write down stock price dynamics. So stock price starts from 50. So initial is 50. If it goes up, then 50 multiplied by up. Okay, 66. This does not make sense, right? Why it is 60? No. Of return. This is wrong. Okay. Okay, is 1.2. It should be 1.2. It's wrong. Okay, then this one also matches. And then if it goes down, okay, it is this one multiplied by this one, F4, right? So I mean, in Excel, I cannot draw this one, so I have this one, and this way. Okay, so this one is 48, right? Okay, so this is the dynamics of the stock, right? This one, right? And then European put option, okay? European strike price is 52, so okay, I compare put option, so if stock price 72, so I sell at 52 minus 72. Okay? So if I exercise option, I lose $20 because I sell $72 asset at 52. It doesn't make sense. So I don't want to exercise asset. So value should be 0. So I compare this one and then this one. If I don't exercise asset, it is 0. So it is this one. Okay. So at 48, if I exercise, because I can sell this one at 52, so I make $4. If stock price is 32, I sell $32 asset at 52, I make $20. Okay. So here, okay, now I can do value here. For this part, okay, I calculate expected value. So this one multiplied by up probability plus this one multiplied by 1 minus this probability, right? Okay, so at this point 0 this one, 1 minus 4 this one, so this is expected value, but I have to discount it back. So I have to discount this one by dividing with simply this one, okay, F4. So it is 1.41475. Okay, so this is this one, same, and I this one, okay, and okay, this one is the expectation of this part, right? H10, H11, C9, 1 minus C9, and discounted, so discount value. So I put 1, then it is my European put option price, 4.1923, right? 26, slightly different, why? I don't know, okay. So I get the expected value of this one, and discounted, so it's European put option price, okay, done. Okay? So I just repeat every time. And next, okay, American put option. In case of American put option, you know, American option is the option that we can exercise anytime up to maturity. In case of European option, we can exercise the option only at the maturity. Therefore, at the maturity, price of American option and European option should be exactly the same, right? Because we are already in the maturity. So the right to exercise until maturity doesn't have any value because we are at the maturity. So in the maturity, European option and American option should have exactly the same value. Right? Right? But now, from this point, now we have now it is before maturity. Therefore, in case of European option, we cannot exercise the option, but in case of American option, now we have right to exercise the option, right? So at this point, okay, in this case, if we don't exercise the option, then it is 1.19753. We know that, right? But what if we exercise the put option right now at this point? Okay, at this point, stock price is 60, right? If we exercise the put option right now, we are selling $60 asset at $52. So we are actually losing money, right? So we don't want to exercise the option at this point, right? So we will simply keep. If we keep, the value is $1.4. If we don't keep, we are losing $10. So we don't want to exercise option, right? So basically, we are compare this value, and then exercise the put option. Put option means that this one minus this one, right? So this part is simply we are holding the put option. This part is what would happen if we exercise put option right now. So we are choosing the max, bigger one between the two. Okay, and okay. Now, interestingly, this value and this value is different, right? Let's check. At this point, when stock price is 40, if we don't exercise the put option, it becomes like a European option. So if we don't exercise put option, my option value is 9.46393, right? But if we exercise the option right now, okay, stock price is 40, strike price is 52. So I can make $12, right? So if I exercise the option right now, I make $12. If I keep option, my option value is just $9.46. So I will exercise the option. I compare between the two. Okay? And I do this analysis again. Okay? In this case, stock price is 50, right? Right? Where again? 아, 참, 네. 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 H10이 아니라 H15가 되지. see 여기서 so I get the expected value of this is okay. So at this point, so again I can get the okay now again I can okay. Now I calculate the expected value of the next two scenario and then discount back. Okay, so this is the value of holding the option, and this part is exercising option. If I exercise option right now, it is stock price $50. I can sell $50 as $52. I make $2, right? But if I hold it, I have 5.0. So actually, I hold it. I don't exercise at this point. So this is initial state. So this is American profit price. Clearly, if you compare this one and this one, American production value is higher than European production value. Right? This makes sense. Right? This makes sense because American option is valuable than European option only if there is a possibility that I exercise option. Right? I exercise option before maturity. If it is useless to exercise option before maturity, right? Then European option price and American option price should be exactly the same. Because the right of exercise option in the middle doesn't have any value. But if American option is more valuable than European option, it means that there is at least one state in which we actually exercise option in the middle. Okay? And this is higher than this one, which means that option is exercised in the middle somewhere. And clearly this one is higher than this one, so option is exercised at this point. And because of at this point, we have a higher value of American option than this one. Okay? Any question? So easy, right? This is your midterm exam basically. You have to make it R, and you have to make these three sides general. Okay. Let's make a more strange derivative price. Okay, strange derivative. Suppose let's assume that there is a handsome salesman, or maybe there is a pretty, there is another pretty investment banker. So let's assume that there is a very pretty investment banker in the Goldman Sachs. Let's assume very pretty and attractive investment banker. And she visits you. And she visits smiling. And she said, and in our company, Goldman Sachs, we developed very innovative derivative. Okay? So we will pay the payoff something like this. Sine, and then cosine, and then exponential of stock price minus 1. This is a derivative, right? This is by definition derivative. This is the underlying asset price. This is a function of underlying. So this is very strange derivative. Okay, so that pretty saleswoman from Goldman Sachs visit you, and we have this interesting financial. So please invest in this product. Please invest like $1 for this product, something like that. Then question is, will you invest in this product? Okay. In order to make a decision, you have to figure out what is the value of this contract, right? If you know the value of this contract, you can invest up to that amount. Right? So let's do a valuation. That's very easy. Okay. We can simply change this last part. So sine, cosine, exponential of this one. Minus 1. Oh. Sine, cosine, exponential h. Oh, I think this exponential, this is too large number. Okay. Okay, so let's get rid of this exponential part. Okay. So this is a too large number, so this contract. Okay, it is easy. We have same approach. So it means that when stock price is 72, Goldman Sachs will pay minus $1.8, which means that you have to pay to the Goldman Sachs $1.8. When stock price is 4, okay, now you have to pay 1.5. When stock price 20, now you have to pay $0.259. So again, we get the expected value of this one and discount. Expected value of this one and discount. So the stock price, why this one is minus? Okay, it doesn't matter. Minus. Then actually the value of this asset is what? Minus $1.3562. Okay. So that pretty saleswoman from Goldman Sachs wants you to invest money, then what? What do you have to say? Oh, bad girl. You are a bad girl. Please don't contact me anymore. Something like that, right? The value of your product is minus. So actually you have to pay me $1.3535862 in order to make investment, something like that, right? Easy, right? So however complicated derivative, it doesn't matter. So Goldman Sachs can even visit your American option of this one. American. So Goldman Sachs in this case, okay, this is terminal price, but you have any time, so it is combination of put option and this one and that one. So of course this is we pay this amount in the middle, but in the middle you have option to exercise put option, something like that. Strike price of 21, strike price of 52. Very complicated contract, but still you can do the valuation, and value of the contract is 3.25, right? Again, at the terminal period, value is this one, but this one is $1.65. But when stock price is 40, if you hold this one, the asset is this one, but now you have the option to sell at $52. So it is a combination of put option and weird derivative, right? So now you make $20, so you get the expected value is $3.25. So if the pre-Goldman Sachs salesman visit you and want to sell, so that you can make a counter offer. Okay? In that case, if please combine your contract with American put option such that I can sell asset, I can sell a stock any time in the middle at the strike price of 52, something like that. Okay? In that case, your contract has now positive value. So now you can invest up to $3.255649. But if that Goldman Sachs saleswoman, pretty Goldman Sachs saleswoman, since she didn't take our this derivative class, maybe she doesn't know what is going on, so maybe you can invest only $2, something like that. Or if you invest only $2, basically you are making money. Any questions? So, I mean, this is the power of a binomial share. You can do the, if you go to it is impossible to have contract derivative more complicated than this one, right? This is a hypothetical example. No contract is more complicated than this one. So you can do the valuation even for this one, right? So which means that now using derivative pricing, we can do any valuation to the derivative pricing for all assets in the world. If I did it based on single asset, right? It is powerful, right? Okay. Let's change it to okay. Go back to the previous ordinary expression. Right? It was very powerful, right? Easy. No mathematics, almost no mathematics. Any question? 질문 있어요? 쉽죠? 그래서 이제 사회 나가면 어떤 데리바티브를 갖다 줘도 다 할 수 있겠지? 예. 얘는 물론 U와 D를 어떻게 결정하느냐에 문제가 있는데, 예. So basically it means that we can do any valuation. One remaining question is, of course, how to determine U and D, right? How to determine U and D. U and D is again very easy. Okay? I'll teach you later, but U and D should be basically U is E sigma okay, I'll teach you later. So this sigma is the standard deviation of stock return for the previous period. Okay, I'll let you know why it is true, why we can use this. It is again risk neutral world situation. In risk neutral world, U and D should be look like this or version of this. This is another intuition for risk neutral world. Now we have all the information, right? In this case, the P is can be calculated from ERT minus D over U minus D, right? U and D, we can use that formula. And this is given by Bank of Korea. This is given by contract. This one is, you can manipulate it. Maturity is given, 2-year maturity is given. So now you can do the derivative for any asset, any derivative. 질문 있어요? 질문 없어요? 네? 이게 뭐든지 데리베이티브 프라이싱 할 수 있는 거야. 못하는 게 없는 거예요, 여러분.